Welcome to the exciting world of finance. This course is designed to introduce learners to the fundamental principles of finance. By the end of this course, you will have a solid understanding of financial concepts, tools, and techniques that are essential for making informed financial decisions. Finance is the study of how individuals, businesses, and organizations manage their money and other financial resources. It encompasses a wide range of activities, including investing, borrowing, lending, budgeting, saving, and forecasting. The primary goal of finance is to maximize the value of an entity while managing risk and ensuring financial stability. Finance can be broadly categorized into three main areas: personal finance, corporate finance, and public finance. Personal finance involves managing your own money and financial decisions. This includes budgeting, saving, investing, retirement planning, and managing debt. For example, deciding how much of your monthly income to allocate towards savings versus spending is a personal finance decision. Corporate finance deals with the financial activities of businesses and corporations. It involves making decisions about funding, capital structure, and investments to maximize shareholder value. For instance, a company deciding whether to finance a new project through debt or equity is engaging in corporate finance. Public finance pertains to the financial management of government entities. It includes budgeting, taxation, expenditures, and debt issuance. An example of public finance is a city government planning its annual budget and deciding how to allocate funds to different public services. To understand finance, it is important to grasp several fundamental concepts: time value of money, risk and return, diversification, and financial markets and instruments. The time value of money is a core principle in finance that states a dollar today is worth more than a dollar in the future due to its potential earning capacity. This concept is crucial for making investment decisions, valuing cash flows, and comparing financial alternatives. The formula for the future value of a present amount is given by FV equals PV times 1 plus R raised to the power of n, where R is the interest rate and n is the number of periods. For example, if you invest $1,000 at an annual interest rate of 5% for 3 years, the future value would be calculated as 1,000 times 1 plus 0.05 raised to the power of 3, which equals $1,157.63. In finance, risk refers to the uncertainty associated with the return on an investment. Generally, higher risk is associated with higher potential returns. Investors must balance their desire for higher returns with their tolerance for risk. The expected return of an investment can be calculated using the formula ER equals the sum of PI times RI for all states I, where ER is the expected return, PI is the probability of state I, and RI is the return in state I. Diversification is a risk management strategy that involves spreading investments across various financial instruments, industries, and other categories to reduce exposure to any single asset or risk. The goal is to minimize the impact of negative performance in any one investment on the overall portfolio. Financial markets are platforms where buyers and sellers trade financial assets such as stocks, bonds, and derivatives. These markets facilitate the flow of capital and liquidity in the economy. Financial instruments are the assets that are traded in these markets, and they can be categorized into equity, debt, and derivatives. Consider a real-life example of buying a car. This decision involves several financial considerations: budgeting to determine how much you can afford, deciding whether to pay in cash or finance through a loan, factoring in the cost of car insurance, and understanding that a car is a depreciating asset, meaning it loses value over time. By applying the principles of personal finance, you can make an informed decision that aligns with your financial goals and constraints. This concludes the introduction to finance. As we progress through this course, we will delve deeper into each of these areas, exploring the theories, tools, and techniques that underpin the field of finance. Get ready to embark on a journey that will equip you with the knowledge and skills to navigate the financial world with confidence. Thank you for joining us in this introduction to finance. We look forward to seeing you in the next lesson.